IR35 is a tax scheme that in short means contractors have to pay more tax. In this video I'll discuss what the problem is, what the purpose is behind IR35, how people are assessed under IR35 and what you can do to challenge an assessment. IR35 is anti-avoidance tax legislation designed to tax disguised employment at the same rate as normal employees. In this context, disguised employment means workers who receive payments from a client via an intermediary, such as their own limited company, but who would have been classified as employees if they'd been paid directly by the client. Before IR35 came in, people who owned their own limited companies were better off from a tax point of view in three ways. First, they took their income as dividends, not salary, and that used to attract a lower income tax rate, although it doesn't anymore. But dividends aren't subject to national insurance payments, which saves up to 13.8% in national insurance contributions. So that's the first advantage. The second is they could set off expenses against tax, often including a proportion of their home utility bills. And third, they could also pay dividends to family members and so take advantage of more than one person's lower tax bands and tax exemptions. It used to be the responsibility of the one-person limited company to decide whether to pay out profit as a dividend or pay the owner a salary. And obviously, even if the owner might be viewed as an employee, if it was tested in court, the company would almost always assess the monies and pay the monies as dividends so as to benefit from the lower tax rate. This meant the state was potentially losing out on many hundreds of millions of pounds in tax revenues. IR35 is a process, meaning that if the individual would be regarded as an employee if engaged directly by the client, rather than being engaged through a limited personal service company, they're taxed as if they're employees, meaning they'd pay more tax. But until 2017, it was left to the contractor's limited personal service company to decide the IR35 status, and you can decide which way that went. Most limited personal service companies decided the contractor fell outside IR35 and so didn't pay the extra tax. And even if HMRC investigated, the worst case scenario was that the personal service company would have to pay the tax shortfall and interest and maybe very, very small penalties, so it wasn't really any worse off than if it had paid the extra tax in the first place. But in April 2021, there's a change to how this works, a huge change. From April 2021, where you have a contractor working for a medium or large business, three things happen. Number one, it's the responsibility of the client, the main business, and not the contractor's personal service company to decide IR35 status. So number one, responsibility for deciding status, employee or otherwise, shifts to the main client, the big business. Number two, if the main business or the client thinks the contractor would be classified as an employee if they were engaged by the main client directly rather than through a limited company, the main business is now responsible for deducting tax and national insurance contributions at normal employee tax rates from all payments made to the limited company. And number three, if the main business doesn't do that, but the Inland Revenue decides it should have done that, the main business is directly liable to pay the tax and national insurance contributions itself. Now, the impact of that is that most of the big clients are veering on the side of caution, even where IR35 probably doesn't bite, and they're deducting employee rate tax, the higher rate tax, because they don't want to take the risk of getting caught by HMRC. Now, this is exactly what HMRC wants to happen, because it means that HMRC is getting more money and contractors are losing out. A medium or large organisation, so one that has to apply these new IR35 rules to its contractors, is any organisation which ticks two of these three boxes. Number one, their annual turnover is more than £10.2 million. This figure normally changes each year. Number two, the balance sheet total is more than £5.1 million. And number three, they have more than 50 employees. So two out of those three, IR35 applies. Now, to be fair, some of those contractors, maybe you, probably shouldn't have been avoiding employee tax in the first place. So if they worked Monday to Friday for just one organisation, didn't have other clients, don't run their own independent business and have just set up a limited company for tax avoidance purposes, it's easier to understand the government's position here. But for those who are genuinely self-employed subcontractors, with multiple clients, with business expenses, it's harder for them to take, especially if they're not getting the benefits of being an employee, such as holiday pay, pensions, sick pay, redundancy rights, and all other benefits. Now, this in fact happened with public sector contractors in 2017, and HMRC estimates it raised an extra £550 million as a result. What's changing is it's being rolled out not just to public sector clients, businesses, but to medium and large private sector businesses as well, with effect from April 2021. Under the IR35 scheme, the client takes a variety of factors into account to build up an overall picture of whether you'd be classified as an employee if you work directly for them rather than through a limited personal service company. I'm going to run through the main factors in a moment, but before I do, if you're finding this video useful, please just take a moment and like the video. Just click the little like, thumbs up symbol below. Go on, please. I'll count to the 3, 3, 2, 1. Thank you. Anyway, the main factors are control. What degree of control does the client have over what, how, when, and where the contractor completes the work? The more control, the more likely they are to be regarded as an employee rather than an independent contractor. Substitution. If the contractor needs to do the work themselves and can't substitute somebody else, that's a pointer towards employment status. If the contractor can send any substitute in their place, that's an important pointer away from employment status. Financial risk. If you take financial risks when you enter into the contract, or if you carry your own insurance or both, that points away from you being an employee. If your fee or remuneration is fixed or guaranteed or based on the time you spend, that points towards employee status. Integration. If you're part and parcel of the client's organisation, for example, if you're on their internal phone lists, if they supply equipment for you, if you have an email address from their company, or you wear their uniform, all that points towards employee status. And if you provide your own equipment, or you have multiple clients and you're genuinely in business on your own account, that points away from employee status and points towards, again, you being a genuine independent contractor and not falling within the IR35 scheme. Her Majesty's Revenue and Customs, HMRC, provides an online quiz tool for you to use to see whether you should properly be categorised as an employee or genuinely self-employed. It's called CEST, Check Employment Status for Tax, and there's a link in the notes below so that you can try putting your own information, your own data in there and seeing what it spits out. The problem is that it often doesn't give a clear answer. A lot of the time it says your status is unclear, and you're then at the mercy of your client, who of course has a vested interest in categorising you as subject to the IR35 rules so they won't get hit themselves with the tax liability. If your client has assessed you as subject to IR35, can you challenge it? Well, the answer is yes and no. The client has to take reasonable care when making its assessment, and it should send you its reasons in writing in something called a status determination statement. It should do that before making the first payment or deduction under IR35. The client also has to allow you to challenge its assessment, and it's got to have a clear procedure for doing so. But, this is the big but, ultimately, as long as they give you a chance to change their minds, it's their decision. There's no legal mechanism either via HMRC or through the courts that allows you to challenge their determination once it's been made. Now that sounds tremendously unfair, and it is, but the government's taken this fairly hard-nosed view that if you don't like what your client has done and you're genuinely running an independent business and it's not disguised employment, you can just go and find a new client. Easier said than done. Now, IR35 is likely to be a fast-moving area, so if I record any update videos, you can watch them here. If there's nothing appearing there, there's no update video. And here is another video you might like. Thank you so much for watching. I'm Barrister Daniel Barnett. Bye-bye.